This is News Talk 980 CKNW.
So talk about a change. There are some indications in the U.S. bond market that are suggesting that the 5,000-year low in interest, I'm talking 5,000, that's not a typo, this could be coming to an end.
And the implications could kind of make your head spin too. For more, let's bring in Michael Campbell, host of Canada's top-rated financial show, Money Talks, right here on CKNW. Hey, Mike.
When I feel old, at least I'm not 5,000 years old, but they go back in all the records historically and go, we've looked at 5,000 years of records for interest rates, and we're at the low. We're it right now.
That's unbelievable.
That's why it's so significant.
Yeah, almost negative rates. Well, there are somewhere, right? Wow. So what about this major trend in changes in interest rates? This is a big story. What is the indication this could actually be happening?
Yeah, and you're absolutely right, because this is in the U.S. bond market, and the U.S. bond market is the biggest in the world. The U.S. is the reserve currency in the world. So, no one really cares if we change our interest rates in Canada. I'm talking internationally or in Australia or New Zealand, let alone anywhere in Africa or, Southeast Asia. They don't care. What we care about is what's going on in the States, and that gets reflected in all our coverage of whatever the Federal Reserve seems to think. So, you've got this U.S. 10-year bond. That's their regular government 10-year bond. Well, it's been in this uptrend of pricing. Pension funds got to put their money somewhere as individuals from around the world are looking for safety, so they pile in and buy the U.S. bond, and that price of the U.S. bond goes up. And remember, interest rates then go down opposite to it. They're inverse. So, we've had this big uptrend going on really since 1980. We've got listeners who might remember, when they were taking out mortgages at 13%, or Canada savings bonds, paying that kind of double-digit return. Well, since that time, it's been this steady downturn, and now all of a sudden, you look at the 10-year bond price, and it looks like it's had a drop. It's changed. It's reversed, and that could be the first really big signal that, man, we could be having a real change here. And I've got a lot of analysts who are running around on this one, and of course, remember, Federal Reserve's chatting that up. But so, that's why, is that they're seeing a change in the price of the U.S. bonds, which are going down. The price of that bond, which means the interest rates they pay on that bond, are going up.
And is this directly relatable back to the Federal Reserve continuing to say it's close to raising but never actually getting to that point?
Yeah, exactly. And they keep on saying, gosh, we hope. September's coming up. The probability isn't high, but maybe December again. But they've certainly created a context for that. The other side of this is, keep in mind that central banks have been phenomenal manipulators of the bond market. And we've heard about stuff like quantitative easing, which in a simplified form simply means that the central banks were sort of printing money and they'd go out and buy government bonds to start with, now in the corporate bonds, even in the stock market. But, hey, if they aren't the big buyers anymore, rates are going to have to edge up again. It used to be, by the way, and you would know this on a personal level, if you're going to lend money to somebody who's a deadbeat, well, you need to get a better rate of return. Somebody who's as creditworthy as all get out, you charge them less. Same in the bond market. But the manipulation is such a degree that right now, Italy and Spain, their government bonds, they get less interest if you bought those than you would if you bought a U.S. bond, which should mean, hey, they're more creditworthy. It doesn't anymore. What it means is when they have trouble, the European Central Bank's going to step in and bail everybody out. So the bond market's kind of broken in that way, but this is still very significant if we see a rise in rates at the longer term, like the 10-year bonds.
Yeah, and we are always influenced by whatever's going on south of the border.
Sure.
If you can say Trump, President Trump, yikes. Anyway, that aside, so what if the rates are going up in the U.S.? What are the implications here?
Well, the first thing is you'd see a stronger U.S. dollar. Can you imagine if you're in Europe and you're getting a negative rate, as you were alluding to earlier, Linda, like you're getting minus 0.5% somehow in Denmark or Germany or Switzerland or whatever, and now you can get 1.5% for the same thing in the States? Well, money moves, just like I'm going to change banks. This bank's offering me more, and they're more stable, actually, than I'm getting now. I'm going to move my money. Well, the U.S. dollar will go up, and guess what? The Canadian dollar goes down. The stock market won't like this at all. We had a really abrupt down move on, I think it was Friday. Then we had a good bounce. Then we got another big down move, on Tuesday. All of that's about worrying about interest rates are finally going to change, because if interest rates did, again, that means the bonds start getting a little more attractive, and money that was going into the stock market forced there because there's not a better interest, they're not getting a good rate of return, maybe comes back. So the market won't like that. But the big one will be capital moving into the States.
What about Canadian interest rates? Obviously, we're here. We're going to be affected somehow. Are we likely to see a shift there as well?
I'm not seeing it because, as you alluded to earlier, Drex, the Federal Reserve has been talking for ages about raising their rates. They did it once so far, but the Bank of Canada has not been. The talk is, are they going to lower their rates? We just got a report yesterday, I think it was out of the Royal Bank, saying that, it was the Central Bank, the Bank of Canada, saying we could be in for a long period of low growth. Well, that certainly isn't the recipe for why you'd push rates higher. We don't have inflation in the country other than in sort of certain assets like some of the real estate, but not inflation in the traditional sense. There's no reason to raise rates. So, yeah, I don't see that. And I might throw one more thing about the personal finance on this one, and that's a relief. I saw a survey yesterday you may have caught that shows that if there was just a 0.25% increase in lending rates, some 700,000 Canadians would be in trouble.
Yeah.
And if they raised by a full 1%, the number of Canadians under pressure would be raised to 1 million. So, yeah, we've created this economy throughout the world that's sort of predicated on very low interest rates. And, the rise is going to cause some disruption. But I don't see it in Canada. But, again, because the U.S. is the big dog, I see its potential there.
Yeah, those people who would be underwater, 699,000 of them right here in Vancouver, no likely with the interest rate. The cost of housing here, nuts. All right.
There you go.
Michael Campbell, thanks for joining us.
Okay, my pleasure.
Vancouver's News, Vancouver's Talk. This is News Talk 980, CKNW.